Hi, welcome to Trade Zone on the 15th of May, 2023, sponsored by Eightcap, and I'm Vee from Track Record Trading Academy. So today we're going to talk about what were the important things last week, how it impacted the market, and what's important this week. So the important events last week in US, there were inflation measures, the consumer price index, as well as the producer price index. And also towards the end of the week on Friday, we had the University of Michigan's survey that showed that the economy is slowing, and there were also inflation expectations component that moved the markets. And in the UK, we had the Bank of England's monetary policy meeting. They made the decision to raise interest rates yet again, and we'll see what they say about that. And also on the week, we saw some inflation data from China, which I believe is quite important, and it will impact the market going forward in significant ways. To start off, let's talk about U.S. inflation. That is the primary focus of the U.S. Federal Reserve right now. They are very worried about inflation. They have been worried for a year now, and they continue to be worried. But on a positive note, the consumer price index for April showed that prices rose 4.9% year on year, and that's below expectations of 5%. And also the previous print was also 5%. So it is slowing as expected, and it's slowing faster than expectations as well. So that's good. The core index, which removes the more volatile components of food and energy prices, rose at 5.5%. It is pretty much what the market expected, and it was also a touch lower than the previous print in March of 5.6%. So that's good as well. And headline inflation is the lowest since April 2021. So we are seeing a continuation of disinflation from the high levels. So it's moderating inflation. It is moderating from high levels of last year. So that's good. However, the bad news is inflation in shelter cost, which is what's keeping prices, the index up, is it remains at a high level of 8.1%. So that's what's dragging inflation, keeping it sticky at high levels, way above the 2% target. And the producer price index, which is a much more leading indicator, the consumer price index, rose 2.3% year on year in April. That's a touch lower again from the expected 2.4%, and significantly lower than the 2.7% we saw in March. Core index, it was at 3.2%, lower than the expectations of 3.3%, and also down from March's 3.4%. So that's good. As we have said before in our midweek update last week, if we should see lower inflation, we will see higher stock markets, risk assets will rally in reaction. And of course, it did. We saw in the immediate release of the CPI data, stock markets, as indicated by the S&P 500 stock futures, rose almost 1% immediately within minutes. And of course, that didn't hold. It is faltered off, but it continued to recover throughout the week until the producer price index, which we saw a brief spike as well, less than 0.5%, not so significant because CPI is a much more important number. But of course, the market was still worried. Is still continuing to be worried about the banking sector and other news as well. So other news being the US debt limit deadline that is looming at the end of this month. So we saw essentially the stock markets didn't move much on the week, but it did had a positive reaction to the good news on the inflation front. However, the dollar, as we said, also it should weaken, and it did weaken in the first instance in reaction to these numbers. But of course, the weakness of risk sentiment as well as higher US yields continue to see the dollar strengthen on the week. And the University of Michigan consumer survey we saw sentiment coming in much lower than expected, below 60. Expectations was around 63. That showed that consumers continue to worry about the economy, but inflation expectations, on the other hand, ticked higher, which is not good news, because it would be much better if actual inflation was going lower, as well as inflation expectations going lower as well. But the most negative piece of news was that inflation expectations over the longer term horizon, 5 years and above, rose to 3.2% from the previous month's 3%. That is the highest we've seen in quite a number of years, and that's what influenced the markets on Friday. So as you can see on the release of the University of Michigan data, we saw stock markets, stock futures drifting lower by nearly 1%. So again, as we showed in the matrix last week, when inflation data comes in lower than expected, we should likely see stocks going higher and vice versa. And that's what we saw happen in real time when this data releases were published. In the UK, the Bank of England raised interest rates by 0.25% to 4.5%. This is the highest level of interest rates since 2008. And more significantly, it shifted its year-end inflation forecast to 5.1% from 3.9%. Previously, in months before, the Bank of England said that they expected inflation to trend towards 4% by the end of the year. I guess they have given up on that. They've started to revise their inflation forecast higher, and they do expect, however, to see inflation hit the target of 2% in late 2024. That's quite a long time from now. It's 1.5 years from now. So I guess they given their projections, they're likely to stay hawkish for now and talk about higher interest rates and the need to keep inflation at bay. However, with more persistent inflationary pressures, they are going to say there's going to be a need to stay vigilant and keep interest rates higher, and maybe even hike even more. But the Governor Bailey, in his statement, he started to disappoint the market on this front. He says, even so, he said that the inflation is on course to halve by the end of this year. The last observation we saw was inflation was above 10%. It's like 10.1%. So by the end of the year, they expect it to be around 5%. And they seem to think they have good reasons to see to think that CPI, Consumer Price Index, will fall sharply from April onwards, which is this month and the months going forward. And they do see signs of food price inflation starting to slow. Of course, we are seeing that in some countries around the world, but just not yet in the UK. And here is the statement. This point he made was also taken dovishly by the markets, because what they are saying is that there will be lagged effects of previous interest rate hikes, and this will be a factor in their policy decisions going forward. So it will mean that they will not be as aggressive as previously thought, right? So because of that, in reaction to the interest rate hike, we saw a spike of 0.35% in the sterling, but when his statements came out, it fell 0.6% because it was quite disappointing to the hawks, right? People would think, for those who were thinking that the Bank of England will need to be very aggressive going forward, they were disappointed because the Bank of England spoke of a drastic fall in inflation from this month onwards, and also spoke of lagged effects from the previous hikes that they need to factor into their decision making going forward as well. On the Chinese inflation front, this was a very good news in my view. Of course, some market participants have written quite negatively about it because they saw that a lower price inflation would mean that the Chinese economy is slowing. But the data first, it fell 0.1% year on year from 0.7. Expectations was 0.4 increase. So this is quite a shortfall. And on a month-to-month basis, it is actually deflationary, right? It's below zero. It shows that prices are falling on a month-to-month basis. That means that inflation continues to drop in China. It allows the Chinese policymakers to continue to implement measures that will boost the economy. So the core index, which excludes more volatile components such as fuel and energy prices, went up 0.7% year on year. Still, that is good. It is way below their 2% target. So it allows them to conduct more easier and implement measures that will boost the economy. The fall in inflation is mainly due to lower food prices as well as transport prices. So logistics is improving. Food constraints, supply constraints are easing. So that's good. Producer price index. This was a significant plunge below expectations, and from the previous observation as well, it fell 3.6% year on year. It means that on a year-to-year basis, prices experienced by producers are dropping 3.6%. It was a drop of only 2.5% in March. It is the seventh straight month of producer price deflation, of prices dropping, and it's observations below 0%. And this is the steepest fall since the COVID crisis in 2020. So many commentators, some commentators to say, were painting this number negatively. They think that it should be higher, given that the Chinese economy is supposed to have reopened completely from COVID restrictions. But I think it would have been much worse if Chinese inflation was trending higher. That would make the likelihood that there is more inflationary pressures in this world. But the reaction we saw was a weakening in the Chinese yuan, likely because the market now expects even more growth boosting measures and maybe even rate cuts on the horizon at some point. So what does lower inflation in China mean? Yes, of course, it could mean what some commentators are saying, lower economic activity in China, or it could also mean, which I believe I'm more firmly in this camp, is that China being the world's largest exporter, Chinese goods that are seeing deflationary pressures like lower prices will cause deflationary disinflation forces being exported to their major trading partners such as the US and the Eurozone as well. So that should be good for the inflation picture worldwide. So what's important this week? This week we have on Tuesday Canadian inflation data points. It is expected to show that inflation in Canada continues to slow, and it's expected to show that prices only rose 4.1%, which is a touch lower from what it was in March. And that should be good for the inflation outlook in Canada. Canada, if you remember, was the first of the major central banks to go on a conditional pause in their hiking cycle. So a continuation in this inflation will see them stick to their guns and keep interest rates on hold for some time yet. The US retail sales is expected to show an increase of 0.7% month to month. It's unlikely to see much market reaction unless it deviates quite significantly from expectations. Here, the Chinese retail sales also on Tuesday is expected to show a big increase of 20% year on year as COVID reopening, as well as growing appetite for more goods continue to show in the numbers. So as we said before, it is not really the Chinese economy slowing that's causing this inflation, but I think it is more likely that supply chains are improving, and also the high base prices of last year is being seen in the data right now. As always, this is this is what we are expecting to move the markets this week. As always, thank you for taking the time to tune in and listen to us. Take care and have a great week ahead.